Imagine waking up tomorrow morning. You get out of bed, pour your coffee, and stroll down to the local ATM. You just want to grab some cash from your paycheck, buy some groceries for the week, nothing crazy. But when you put your card in, the screen just blinks. Transaction denied. Okay, weird, right? So you walk over to the actual bank branch, and the doors are locked tight. There's just a piece of paper taped to the glass telling you that your life savings have been legally frozen by your own government. Every single cent you've ever worked for, securely deposited, is just gone. You can't pay your rent, you can't buy food, you are literally locked out of your own money. Sounds like some crazy dystopian movie plot, doesn't it? But for millions of hardworking people, this wasn't a movie. This was a sudden, terrifying reality that destroyed their lives literally overnight. And the absolute wildest part about this whole thing? They had absolutely no idea it was coming.
Welcome back to The Explainer. Today, we are diving deep into what I call the ultimate financial trap. We're breaking down the complex anatomy of a staggering $132 billion collapse. I am absolutely pumped you're here today because we are stepping right into the middle of one of the most suspenseful, jaw-dropping financial thrillers in modern history. Like, how does a wealthy, highly developed nation just implode? We're talking riots in the streets, helicopter escapes, and the legal confiscation of civilian bank accounts. Well, the ending of this story is a complete mystery if you don't know the history. So to understand how a massive economy goes completely broke, we gotta rewind the clock a full 10 years. Picture a country completely paralyzed by hyperinflation. And I don't mean standard inflation. I'm talking about an inflation rate of 5,000% in a single year. Prices were literally changing at the grocery store while you were standing in the checkout line. Pure economic chaos. So in 1991, the government pulled out what they thought was this absolute magic bullet. They called it the Convertibility Plan. Basically, by law, they pegged their struggling national currency exactly 1-to-1 with the US dollar. By mandate, one local unit equaled one US dollar. And every single unit in circulation was supposedly backed by a physical dollar sitting in the central bank's vault. And you know what? It worked like magic. Inflation dropped from 5,000% to near zero almost overnight. Suddenly, regular citizens felt incredibly wealthy.
Okay, let's really dive into this for a second because it looks like an absolute dream on paper, right? Zero inflation, incredibly cheap imported goods, foreign TVs, cars, you name it, pouring into the country, and average citizens could suddenly afford these luxurious foreign vacations like never before. It was a massive economic boom. But when you flip over to the other side of the ledger, a huge trap was forming. See, when your currency is artificially strong like that, your exports become incredibly expensive to the rest of the world. Nobody wants to buy your agricultural goods or your manufactured products because they just cost way too much compared to the competition. So domestic industry started to absolutely suffocate. Factories weren't selling goods abroad, and here's the really dangerous investment mechanism hiding underneath this whole entire boom. To maintain this one-to-one illusion, right, and keep the dollars flowing into the central bank to back up their own currency, the government had to rely on massive, continuous foreign borrowing. They were essentially funding a nationwide economic party with a gigantic, high-interest credit card. And, well, we all know what happens when you just live on credit.
For a few years, honestly, that credit card bill didn't matter. The money was flowing, everyone was happy. But then, the global market started to violently shake. Between 1994 and 1999, this wild domino effect of financial crises ripped through emerging markets all over the globe. First Mexico in 94, then the Asian financial crisis in 97, Russia actually defaulting in 98, and finally neighboring Brazil in 99. Now put yourself in the shoes of a global institutional investor for a second. You're sitting there, you see emerging markets collapsing all over the world. What do you do with your capital? You pull it out. You run to safety. So to convince these nervous global investors to keep buying their sovereign debt, our mystery government had to start offering excruciatingly high interest rates. The cost of financing their mounting debt was absolutely skyrocketing. The local economy was beginning to stall out completely, and man, the walls were really starting to close in.
The illusion was officially cracking under all that pressure. And that country we've been talking about? It was Argentina. Throughout the late 1990s, Argentina's unyielding currency peg plunged the nation into a grueling, multi-year recession. That fixed exchange rate, which everyone originally hailed as this brilliant economic miracle that saved the middle class, it had become a suffocating straitjacket, actively destroying them. Because they legally couldn't devalue their currency to make their exports competitive on the global market, businesses just went bankrupt. Factories completely closed their doors. Unemployment absolutely soared. By the turn of the decade, an unimaginable 50% of the Argentine population fell below the official poverty line. People were getting really desperate, but the government absolutely refused to abandon the one-to-one dollar peg. It was basically viewed as political suicide to even suggest touching it.
So, by 2001, the Argentine government was literally running out of cash to pay its debts. Enter Economy Minister Domingo Cavallo. In a super desperate financial maneuver, Cavallo orchestrated what was called the Megacanje, or the mega swap. Now, I know this sounds like highly complex Wall Street jargon, but here is the simple, terrifying reality of what it was. Argentina could not pay the $30 billion in short-term debt that was coming due. They were completely broke. So Cavallo swapped those short-term bonds for long-term bonds, effectively begging the international markets for more time. Just give us a few more years, we'll figure this out. But the catch was absolutely devastating. To get investors to actually agree to this massive delay, he had to add $38 billion in future interest payments. So he didn't solve the insolvency problem at all. He just strapped a much, much larger ticking debt bomb to the Argentine economy and hit start on the timer. Now, what's really interesting about this slide is how the global financial markets reacted to this desperate move. If you track the Treasury bond yield spreads, which basically just measures the risk of a country going bankrupt compared to incredibly safe U.S. Treasury bonds, the panic is mathematically visible right here. In July 2001, the spread was at 9%. That's elevated, but maybe manageable. By November, as the panic really set in, it hit 16%. And by December, an unbelievable 42%. Mathematically speaking, a 42% yield spread is the bond market screaming at the top of its lungs that this country is completely insolvent. No one, and I mean literally no one, on Wall Street or in global finance believed Argentina could actually pay its bills. The institutional investors saw the writing on the wall, and the tension was just about to snap.
And look, when the smart institutional money realizes the ship is sinking, they head straight for the lifeboats. By late November 2001, an absolute financial panic swept the nation. A deadly bank run began. Huge corporations and wealthy individuals started furiously converting their pesos into dollars. They electronically transferred them to safe offshore accounts as fast as they could. And everyday citizens? They caught wind of this. They rushed to their local bank branches to pull out whatever physical cash they had. In a matter of mere days, investors and citizens withdrew an astounding 25% of all the cash in the entire Argentine banking system. Now, think about how fractional reserve banking works, right? Banks don't actually hold everyone's cash in a giant vault. They lend it out. So if everyone asks for their money at once, the money simply isn't there. The entire banking system was literally minutes away from total, catastrophic annihilation.
The government had to take drastic action right then and there to stop the bleeding. So on December 1st, 2001, they dropped the absolute hammer on the Argentine people. They enacted an emergency policy informally known as the Corralito, which essentially translates to the little playpen. The government legally locked the doors on the banking system. They restricted citizens to withdrawing a mere $250 a week in cash from their own accounts. Everything else was completely frozen. Just imagine looking at your banking app right now. You see your life savings sitting right there on the screen, but you know you are legally forbidden from transferring it or withdrawing it or doing anything with it. The capital you had built over decades was suddenly trapped behind bank glass. It was completely inaccessible to you, all just to keep an insolvent banking system on life support. As you can imagine, the societal reaction was explosive. The middle class, people who had played by the rules, paid their taxes, and trusted their banking institutions, were suddenly locked out of their livelihoods. They couldn't pay for daily necessities or run their small businesses in what was still a very heavily cash-based economy. So they took to the streets in this massive, spontaneous uprising known as the Cacerolazo. Millions of ordinary citizens poured onto the grand avenues of Buenos Aires, and the protests were characterized by this deafening, non-stop banging of pots and pans. It was the sound of a completely betrayed middle class. They were expressing raw, unfiltered rage at a financial trap that they had been violently forced into.
The tension finally snapped in the most tragic way possible on December 19, 2001. With protests turning into full-blown riots and looting spreading across supermarkets and businesses nationwide, President Fernando de la Rúa appeared on national television and officially declared a state of siege. But man, this extreme measure only enraged the population even further. The clashes between demonstrators and federal police forces in the historic Plaza de Mayo turned incredibly violent, tragically resulting in 39 casualties. By the very next day, the situation was completely ungovernable. The streets were literally ablaze. And in one of the most iconic, dramatic images of the entire crisis, the president of Argentina was forced to resign. He literally fled the executive mansion by taking off in a helicopter right from the roof.
So the crucial point is, what's just wild to realize when you break this all down is the sheer unimaginable political chaos that followed that helicopter ride. The highest office in the land basically became a poisoned chalice. In the span of just 2 weeks, the nation burned through 5 different presidents. Yeah, you heard that right, 5 presidents in 14 days. Just imagine updating your resume as the president of a country, but you only actually worked there for a long weekend. Nobody wanted to be the one holding the wheel as the national economy drove straight off the cliff. There was absolutely no stable leadership, there was no clear plan forward, and the international financial markets just watched in absolute horror as a major G20-level economy completely unraveled in real time.
And then came the inevitable detonation. During the last week of 2001, the newly formed interim government officially declared a sovereign debt default. The number was absolutely staggering, a massive $132 billion. At the time, it was the largest sovereign debt default in the history of the world. Argentina essentially stood at the podium and told its global creditors, the IMF, and all its foreign bondholders, look, we have no money and we are not paying you back. The consequences of that were instantaneous. Foreign investment ceased immediately. Capital flows stopped dead in its tracks, and the country was completely, utterly cut off from international credit markets.
But hey, what about that famous one-to-one currency peg, that magic bullet from 1991 that supposedly cured all their inflation? Well, in January 2002, economic reality finally caught up. The government was officially forced to abandon the decade-long convertibility plan. They simply did not have the physical dollars in reserve to back the pesos anymore. It was a mathematical impossibility. So they allowed the peso to float on the open market, and exactly what everyone feared happened. The currency rapidly and violently devalued. That incredible illusion of wealth we talked about earlier, it just vanished into thin air. The purchasing power of the entire nation was decimated almost overnight, sending the economy into an even deeper, darker tailspin.
But honestly, the absolute worst was yet to come for the everyday citizen. If you remember the corralito from a few minutes ago, citizens still had their US dollar savings completely frozen in the banks. Well, in early 2002, the government introduced the corralón, the big corral. This was the final devastating blow. The government decreed the forced asymmetrical conversion of all US dollar bank deposits into the newly devalued local pesos. I mean, they basically invented a brand new word for legally robbing you. They called it pesification. It was a mandatory conversion of your hard, safe currency into a crashing, volatile currency entirely without your permission.
And this brilliantly illustrates the brutal math of this policy. It is staggering when you actually compare the rates. The government forced the conversion of citizens' dollar deposits at a fake, official rate of 1.4 pesos per US dollar. So, okay, if you had $100 frozen in the bank, they gave you 140 pesos. But out on the actual free market, the exchange rate had already spiked to nearly 4 pesos per US dollar. So by doing this, the government mathematically evaporated the public's wealth overnight. It allowed massive, insolvent companies to pay off their dollar-denominated debts on the cheap, while totally and completely sacrificing the savings of the middle class to foot the massive bill.
The human cost of this financial trap was agonizing. By the time the dust finally settled, everyday depositors, the people who trusted the system, the people who didn't offshore their money when the smart institutional investors did, they ultimately lost roughly 65% of the real value of their life savings. 65% wiped out by government decree. It is a stark, terrifying reminder of the absolute devastating consequences when poor financial policies, massive unsustainable debt, and crazy currency manipulation finally collide with the harsh reality of free markets. Because guess what? The math always wins in the end. Which really brings us to a chilling question to wrap this up. If a government guarantees your currency is safe, if they promise your bank deposits are secure, is it ever truly a guarantee? The 2001 Argentine crisis shows us that when the math stops working, the rules of the financial game can be rewritten literally overnight. And it is almost always the everyday citizen who ends up paying the ultimate price. I really hope this deep dive into financial history opened your eyes to how interconnected, complex, and honestly fragile these economic systems can be. Keep learning, keep questioning what you hear about money, and I will catch you on the next explainer.